All right, everybody. Happy Tuesday. So, for those of you that just got here, we are going to start today's lesson by going over what we did in lesson one, and then we will move forward with our second lesson. So, let's just get this done quickly. So, last Tuesday, we started to talk about buying and selling and kind of the general idea of how markets work. Um, we wanted to get a better understanding of price action, and we're going to follow up on that today. And we kind of needed to set a baseline for the general mechanics of buying and selling, right? So we started to cover what happens when we have one buyer and one seller, what happens when we have one buyer and multiple sellers, and then what happens when we have multiple buyers and only one seller, right? So we started to briefly touch on the concepts that are going to help us understand how the market is driven. Uh, Overall, this is more of an intro to supply and demand, right? We generalize this by saying usually if there's more buyers, sellers can push the price up, and if there's more sellers, sellers tend to have to move the price down to find somebody willing to purchase. We did a couple of different analogies, right? So we talked about some of the methods for tracking this buying and selling. The main one was if we have a box of receipts, right, and we can see every individual purchase, it becomes a little bit difficult to organize, maybe even a little bit unruly. And we compared this to the time and sales module that we have on Traderlink, right? This is something that's going to show you every individual order, but there's a lot of information. It's kind of hard to mentally quantify this and remember what it looks like historically. So we kind of covered, maybe it's too much information in one module, and is there any alternative that we could have to keep track of this, right? To help us understand what's going on, to help us see the buying and selling and make sense of it all, right? So we looked at two other tools, the first one being the volume profile, and we started to discuss why looking at volume at price versus volume over time, like your broker shows you right out of the gate with the chart, is is kind of a different way to view the market, right? Volume over time is beneficial, but understanding exactly where that volume, where that buying occurred, gives you a little bit of a better read. And then from that point on, we started to move over to the footprint chart, which is kind of a combination of both the time and sales and the volume profile in one tool, giving you the ability to see volume over time, but also at individual price points. And it gives us an easier way to see the buying and the selling over a specific time, which, we need to, as traders, understand what levels people are looking to buy at, where things tend to be undervalued, and what level people are selling at, where we consider things to be overvalued, right? We did some basics on the candles, right? Candle composition and understanding why the basic candles that you get on your broker are not necessarily giving you the full picture. We had another analogy there where we're looking like the outside of a box. Here we know that there are things inside of these candles, but just at first glance, we don't know where the majority of the action is happening, or really the composition, like where are things being bought, where are things being sold, without looking at something like the footprint chart, which gives us more clarity and helps us see what's inside of those individual candles. And ultimately, that granularity is going to give us the information that we need to make smarter decisions. And that's basically where we ended off last class. So for this class, we're going to talk about markets, right? In the previous lecture, we were starting off discussing grocery store type of analogy, right? We were looking to buy an apple, something that everybody is quite familiar with. We're not going to move too far from that in this specific example, but we do have some new questions that we kind of need to touch on before we go much further, right? So we need to look at what the difference is between a low and a high volatility market. And I think before we go further, we should really touch on this. So last class, when we were discussing an apple, right, at a grocery store, this is a very good example of what I would consider to be a low volatility market, right? If you are based here in North America, we don't really have much at a lot of our stores as far as a bartering system goes. In other countries, it's a little bit more prevalent. But here, you basically go into a store and you are expected to pay what you are told, right? There is no wiggle room, and the price is the price, and that is what you have to pay. Because there is no real way to change the price, there's no real fluctuation. This is what I would consider to be a low volatility market, right? And we need to kind of shift our understanding of the markets if we're going to look at the stock market, which is a high volatility market, right? So we're gonna go into that in the next slide. The other questions that we want to look at is how does the price of a stock change, right? If in our previous example, we know that the price of an apple is rarely going to fluctuate, how do stocks move? Right? If all we're doing is buying and selling one way or the other, like what is really the driving force in this movement on a day-to-day basis? We've all seen the stock market, the price never stays the exact same, right? To the cent for very long. There are always fluctuations in price, whether they are large or small. It is always kind of in flux, right? Another thing that we're going to kind of answer is if there's always a buyer and a seller, how does the price move? So, for some of you that have had previous experience, some people tend to categorize, the tape or us going up or us going down as like buyers stepping in or sellers stepping in. And this is kind of true to a point, but every transaction in the stock market has to have a buyer and a seller. So, if in order to complete this transaction, there's one on either side, do we need to come up with a little bit of a different terminology to understand what's really going on here? And then we're going to start to dive into how do we read time and sales, how do we read volume profile, and how do we read the footprint. I would like to give a little disclaimer before we even start this lesson. The images that I have chosen for this are probably not going to be what we use for the final course material. So just bear that in mind, but it should be good enough to kind of get the point across for what we're talking about today. So last lesson, we were talking about being in a grocery store buying an apple. To understand kind of the shift into more of a high volatility market or a market where prices are able to fluctuate a little bit easier, we're going to be looking at this as though we were going to a yard sale, right? Somewhere where we have a little bit of leeway. The price can come down, the price can go up, and we're going to look at it through that lens. So yard sale should be two words here, so I apologize for my grammar. Today, we're going to assume that we're at a yard sale and I am looking to purchase a golf club that I found there, right? So there's me over on the left. I am the buyer. The seller, obviously, on the right. He seems kind of angry, but that's okay. Can't play golf anymore. In the golf club that we're looking at right now, we have a price of $5 on the tag, right? Simple, straightforward. When we go to this yard sale, let's assume that at the beginning it's just me and this old guy. And if I was going to pay $5 for the golf club, he'd be fine with it because there's nobody else there. In this situation, unlike the situation where we were at the grocery store talking about apples, let's assume that now there are two people, at a yard sale. We're walking in off the street, there's a couple people there, and we're both looking at the same thing, right? So even though it was priced at $5, now the seller, because there's me and this other guy who looks to be my exact clone, we're both looking at the same golf club. He could ultimately, charge more money. He seems a little grumpy, so he seems like the kind of guy that would do this. There's two people looking to buy. He's not going to give it to the first person. He's going to give it to the person that is going to pay more money. So in previous slide, you can see that the golf club was $5. In this case, he has now raised the price to $6, right? And this is just a pretty simple example. When there are lots of people looking to purchase something, the seller has the ability to manipulate the price to get their maximum benefit from this sale, right? It doesn't necessarily need to be a dollar. It could be $5 more, it could be $10 more, whatever. But because there are multiple people looking to buy and there's only one thing for sale here, there's only one golf club available. This puts the buyers against each other, right? How bad do you want this golf club? And are you willing to pay more for it? Now, if we look at it from the other side, let's assume that there are now two yard sales, right? They're side by side, and they both have the exact same golf club, and they know it. And they know that I've gone to both, and I'm the only person looking for this golf club. Now, the opposite situation is going to kind of occur here, right? Where the sellers are now kind of battling it out amongst themselves to make the sale. They know that after this yard sale is over, they don't want to be left with this golf club. They're probably going to throw it away anyway. So they have the ability now to lower their price to make the best deal for me, right? Me as an individual, I'm probably going to pick, assuming that the golf clubs are the exact same wear, same brand. I will probably go through this situation and I'll buy the one that's cheaper. If they originally had both golf clubs listed for five, they are now in what we would consider to be a race to the bottom, right? How much can they lower their price by uh, until a point where they can't sell it for any lower? And will I go to that, right? So in the first example, right, just me, $5. We would agree on $5. That'd be it. Bing, bang, boom, done. We're buying it for five. The next example, there are multiple buyers looking to buy one thing. The seller has the ability to increase the price, right? Only one person's going to be able to get it, so they're going to try and maximize their return. Or option three, right? Now there are two sellers selling the exact same thing. They need to compete against each other to complete the sale. There's only one person looking to buy something, and there is more inventory than people willing to buy. So they know that they need to get rid of this. So that's where they start to drop their prices. So, how does this kind of relate to us in stocks, right? We haven't really taken any of these examples and compared them to anything in the market yet. And this is the time to do that, right? So, we can start to look at what we would call the mark, the bid, and the ask, right? So, the mark is kind of the general agreed upon price. This is where the buyers and sellers want to be. This is usually the middle, the midpoint between the ask and the bid. Our example one, right, where we agree it's $5. Nobody's trying to raise the price, nobody's trying to lower the price. That would be our mark price. That's the agreed upon thing. We're both doing okay here. There's no pressure on the buyer. I don't have to worry about somebody else buying it out from under me. And he knows I want the club. So we agree on a price. This is similar to the Apple scenario that we were discussing at the start, right? We're not rushing to buy apples. There's not a shortage of apples. This is just the agreed upon price that anybody is willing to pay for this. Now, the ask and the bid reflect the two other examples, right? So the ask is the higher price and the bid is the lower price. So when we are paying at the ask, you can kind of see. So transactions at the ask mean that there is buying pressure, right? So this would be the instance where there are two people looking to purchase the same item. There's only one, right? Buying pressure means that we are willing to pay more than what the actual value is at its current time, right? Because it could be a million reasons. There could be other people that are looking to buy it. We don't want to miss out. We want to get in. You see a lot of people when they're purchasing any sort of stock, you're rarely going to get filled the mark. If you are buying, you usually have to buy at the ask because you are competing with other buyers. Typically, this means that there is less supply than there is demand, right? So in the instance that we had before, there were two people looking to buy and only one item, right? So the supply is one, the demand is two. That price can go up. If you want to be able to make the purchase, you sometimes have to pay more than the mark price, which is $5, right? The third example was the opposite of this. So transactions at the bid usually means that there is selling pressure and the sellers are willing to sell for less. Typically, this means that the supply is more than the demand, right? So here, our supply is two, but there's only one person willing to buy, right? Only one of these people is going to sell their clubs. So they need to drop the price to make it a better deal for me because they are pressured to sell. If they do not sell, they're just going to have this inventory. They don't want it anymore. They want it gone, right? This yard sale, when it's done, everything's going to the dumps. They're going to get what they can for it. And that usually leads to a decrease in price, right? So when we see things either go in at the ask or at the bid. When enough transactions occur at the bid or the ask, the accepted value of the product changes, right? And then that shifts the bid, ask, and the market in that direction. So if there were enough people buying golf clubs, it's $6 and our accepted price is five, at some point in time, the accepted price is going to go up. We've had enough people buy at $6 that $6 will ultimately become the accepted price, right? And then the ask shifts to seven and the bid shifts to five. So everything moves up by $1. When there is buying pressure, right, and we start to pay more for something, the accepted price is also going to go up to reflect that, right? We can't just say that the price of the golf club is $5 and we're paying six. People that are selling are smart, right? They know that 100 people now have paid $6 for a golf club. Well, now maybe it's time to increase our prices. The same can be said in the exact opposite situation, right? Excuse me. If enough golf club sales get sold at the bid, right, a lower price, then that becomes the accepted price, right? So on our charts, this would be the equivalent of a stock moving up and then the equivalent of a stock moving down, right? If people are buying at the ask, it's going to go up. And if people are selling at the bid, right, they're trying to get rid of it, the price is going to go down. What you should notice here is that only buying at the ask and at the bid is going to have an impact on price. If we continually just made deals at $5, right? Everybody bought and sold clubs for $5 and that's it. That's all. Nobody paid more, nobody paid less. The price is always going to remain the same. So in order for price to change, there has to be people willing to either pay more or sell for less, right? In a perfect world where we're in total equilibrium, we're spending $5 on this club, and a year from now we're spending $5 on this club, and 10 years from now we're spending $5 on this club. The price would not change. There has to be people willing to either pay more or sell for less to impact the actual value or the perceived value of this item, right? So sometimes if you really, really, really want to buy something, you're going to pay even over what the ask is, right? In terms of the stock market, if you're trying to get into a position and the stock's moving very quickly, you will pay more than the ask price, right? So you'll go over the ask. And this just shows that you really want this, right? It could be based on time, it could be based on limited quantity, right? If you're thinking about a shoe or a limited edition clothing item, right? Sometimes you're willing to pay more just to get that because the quantity is so limited. And sometimes you're so motivated to sell, like this is a great example for a yard sale. You know, you just want to get rid of the golf club because you know that its value is going down. It's kind of a pain in the ass. You don't want to keep it in your garage forever. Somebody comes in and they offer you $3 when it's marked for 5, and you're just like, all right, fine, take it. That kind of shows seller motivation, right? The buyer doesn't have to pay more. The buyer has control over the situation, right? You are willing to take less money just to get rid of it. So what's this mean? So orders that are at or over the ask tend to push price up, and this is a reflection that buyers are willing to pay. People want this. This could be based on supply and demand. This could be based on news. There are several different catalysts, but in a stock perspective, when you are buying at or over the ask, it is showing intent that we want this thing, right? For whatever reason that is. And then the inverse is orders that are at or under the bid tend to push the price down and reflects sellers trying to get rid of something, right? This could be taking profit. This could be, again, another news catalyst. Maybe there was a BP oil spill and everybody's trying to get rid of their shares while they still can because the price is going down, right? You're selling it as quickly as possible for whatever somebody will give you, right? That price goes down. You just keep selling to try and get as much value out of it as you can at that point in time. And orders at the mark are neutral and do not change the price, right? So we're going to go over kind of how that works because in the volume profile, we actually can't really see either of these, but in the footprint, we don't track orders at the mark at all. So just to recap here, orders that are at or over the ask tend to be bullish, right? That usually price usually reacts and moves up. Orders that are at or under the bid tend to be bearish, right? Price goes down, and orders at the mark are neutral. This tends to not move price whatsoever. I would just like to leave a little disclaimer here. This is true for stocks, right? When we start to dive into options and we start to look at the unusual option side of things, this is not always the case, right? A stock is like a physical thing, but because options can have calls or puts, sometimes selling one or the other actually does not mean bullish or bearish. It means the opposite. So I just want to make a little bit of a note there. So just a quick question for you guys. How many of you are using Thinkorswim and have seen Active Trader before? Which is what this screen is, just so I can like, is there anybody here that has never used Active Trader? Nobody. Everybody's used active trader. You have not. Okay. So active trader is a way to place orders, right, on thinkorswim, and I think this is the easiest representation to move from, sorry, from this, right, what we're looking at with the ask, mark, and bid, to what actual stocks kind of look like when we're buying them. So here in this, you can see that we are looking at SPY. So the S&P 500, this was from earlier today, I think around 11 PST. And the mark, right, is 590.25. Anything over the mark is going to be either ask or over ask, and anything under the mark is going to be bid or underbid. So in this specific instance, you are able to see, right? So these little red things, these are orders that are trying to sell. And on the left is orders that are trying to buy. So everybody wants to buy for as little as possible, and everybody wants to sell for as much as possible, right? What happens here, or over mark, right? What happens here is if you were to leave an order, right, and you're going to buy and say that the mark value is 590.25 and you want to fill at 590.24. If there is no selling, you will never get filled, right? Because you are only going to fill an order like that if you are at mark or above, right? If this stays the exact same. So in a case like this, if I wanted to buy, it is very likely that I need to spend at least 590.25, but to increase my likelihood of actually getting filled on the stock, I need to go over that. You can see that these are where the sell orders are, right? If I go to 590.26, I'm going to get filled right away. There are 26 people or 26 orders looking to sell here. And then one at 590.27, 18 at 590.28, right? And then the opposite is true. If I am trying to sell up here, I am likely going to only start filling orders if I sell at 590.24, right? Because this is where people are set with limit orders looking to buy. Does that make sense for everybody? This is where things start to get into the stock market, because when we're dealing with physical inventory, right? All we can do is hand somebody the money and they can say, here's your golf club, right? But when we deal with the stock market, we have different order types, right? So I can say, oh, if the price of the S&P 500 comes to 590.23, I'm willing to buy then, right? I can't go to the yard sale and be like, when you are willing to sell this to me for $4, hit me up and I'll buy it. You know, Usually doesn't work like that. So the stock market, because it's electronic, it does make it easier to do that, and we get a good visual representation here. So for those that have not used active trader, sorry, those who have not used active trader, this is probably the easiest way to start visualizing the buying and selling and where people are, right? If you're trading off your phone, a lot of platforms don't have this. This is the bread and butter for understanding the buying and selling, because this is one of the only ways that you can see where people are willing to buy and see where people are willing to sell with like an actual numeric value. All right. So that's the basics of, buying and selling. We're at or over ask, we're bullish. We are at or under bid, we are bearish. So I did a little screen recording here and we're just going to watch this out, and we're going to start just by looking at the time and sales here, right? So you can see a lot of orders in white, some red, some a red background, some green, some a green background. The main thing that I want you to see is how quick this information is coming, right? So our main takeaway from last week was that sometimes when we get individual receipts, it becomes hard to remember what you're seeing. Like, what was the first order that you saw? Can you remember 5 orders back? It's sometimes there is such a thing as too much information too quickly, right? So what does that mean, right? Orders that are red are at the bid or under mark, right? So right now you can see that our mark should be somewhere around 590.86. You can see on this last order right here. When an order comes in at 590.85, that is under the mark, right? So that is closer to bid. So it is red. The opposite is green, right? So you can see the mark here was 590.855. And somebody bought at 590.87, right? So if we go back to this example, right, the green are basically orders coming in that where people have buying, they're buying initiative. So if the mark is 590.25, green text is going to be an order coming in at 590.26, 590.27, somewhere around there. The red, just the red text is going to be the opposite. That's going to be orders that are under mark, right? So 590.24, 590.23. And any of those lines that are just white, they are coming in exactly at the mark, right? They are not moving the market. People are getting filled right in the middle between the bid and the ask. So if we keep watching, we can get a couple other examples here. Give me, no, 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 pretty flat. There's some greens, there's some red. All right. So we can see the difference here, right? So we had some red text, some green text, and then now on this screen, we can see some red background and some green background, right? The red is underbid and the green is over ask. So when you see something on the time and sales and it has a filled in background, that is very initiated buying or selling. So that is the equivalent of here, right? We're trying to get rid of it. Red background means that we're underbid, right? So we're even lower than what the accepted bid is, where we could probably get filled. We want to get rid of it, right? And then the green background is over the ask, which means that we are really trying to buy, right? We're willing to pay more money to get this and get this right now. So here's a little recap just on the time and sales. What we should take away from this, right, is that it might be difficult for you to see or remember the individual orders. But it is very obvious when you see large blocks of red or green to kind of see where there's massive buying and selling. So we saw that at 590.91, there's a ton of selling, bunch of red, right? Bunch of green right there. Let's go back 2 seconds, right? Oh no, it's so hard to find sometimes because it is quick. Not even going to be able to find it. This is again, yeah. So you can see here, massive block of buyers coming in, 590.6 or 590.96, 590.7. Bunch of people were willing to buy. It's not a ton of money. You couldn't even see this, right? If you blink, it's gone. Gone. Wouldn't even be able to read that. And this kind of goes with what I was saying in the last class, where time and sales is great. There's a lot of people that teach time and sales, and I think that there are some people that are really good at reading it. But for people like me that have either short attention spans or I'm looking at a bunch of charts, I find that it's not the most efficient method to understand what's going on. Because again, I ask you here, find one order in here. By the time you go through and you see the value, you see the lot size, you see, what the price point is, it's gone. When it's moving fast like that, it's almost impossible to see what is actually executing and where. Doesn't mean it's not useful, doesn't mean that people can't leverage this, but it's not easy. You know, this is when I started trading, this is kind of where I started because I didn't have access to footprint. I didn't have access to volume profile when I was trading. So I'd sit for hours trying to understand the tape, trying to get better at reading the tape. And it worked, but I always thought that there's got to be a better way. Like this is the equivalent of what we were talking about in lesson one with apples. It'd be like taking every single receipt, and as a receipt comes to you, you have to read it. And then there's already 10 more receipts that have piled up. You have to read all those. And then somewhere in there, you need to be able to calculate. It's like, well, are more people like buying or more people selling? And you know, outside of just seeing where large orders or where really initiated buying and selling is with the backgrounds, I find this to be a little bit complicated. That's easy to read sometimes. And it's good when you're at a level of importance. Like this was today around 11:02, which was right around high of day, right? So this is kind of an interesting place to see. This is right around what, 591, but not the easiest to understand. Everybody understand at least the color coordination here? It's easy to digest what it is, right? Do you all understand that? But it's not necessarily easy to read and to quantify yourself. So before we get into the footprint, we are going to go over the volume profile quickly. So just here, because it was loading partially through this video, we're going to cover two things. The first one, and the first thing that we always want to look at, are where are the high volume nodes, right? So areas where we have standout volume. So the first one is obviously going to be our highest volume, which is right around 585, 586, 585, excuse me, 585.4. So this block, I think, can you guys see my mouse? Like if I'm circling things with my mouse, can you see it? Yeah, okay, cool. So we have, this is the main volume node, right? But we know SPY moves and we're trading at this point at 590.845, right? We don't really care so much about 5 points down if we're day trading, right? So what's the next area of volume that we'd want to look at? Well, what's the second kind of grouping of volume by price? And we see that up here, which is around 589, 589.2-ish, right around here, right? That's pretty close. And then you can see above that, we're trading in areas where there's little to no volume. Everything is gray. It doesn't look like much was even executed between 589.6 and, 590. There's nothing here in relation, right? So when we're looking at volume profile, whether we're above it or below it, we tend to we want to use these as levels, right? So if we're trading over it, what we want to see is a reversion back to it. I don't think we're going to come all the way back to 585, at least in one day, right? There's only had like 3 hours left in the market. But, dropping a point, point and a half, coming down to 589, that's very feasible, right? So this is all we're doing. So a lot of people struggle to find support and resistance levels when we're starting. Am I just drawing a line because of these candles? It's not always super practical, but we get more information here. Why are we doing more work when we can let the tools do the work for us, right? If we are looking for levels, and we always need a level because we need to kind of have at least a general idea of where we'd like to enter or where we'd like to exit, why wouldn't we just use where the volume is? You know, why wouldn't we just look at this and be like, oh, well, we're trading over both of the major volume levels. I don't want to buy at the top, right? I think that we're going to come down to at least one of these. And when we do, I'm going to see what price does at that point in time, right? So here we're trading right around 591. For me, I would look at this and immediately go, well, today we're not going to get to 595 bearing some crazy news, but we could come down 2 points. So for me, if I'm looking to do anything, I would like to see a retest of this level. And what happens, I think that I have a photo of this, right? So this right here is what we see on this block, this gray area is what we're actually looking at on the footprint at this point in time. So we are trading right around, I think it's this candle, this red candle is where we're at. This is 591 right up here at the tippy top, right? If we're just looking at the volume profile, the easiest thing would be, hey, let's wait for a retest of, pretty close to 589 and then go from there, see how price reacts. Maybe we take a long. If it breaks, it looks like we might be able to short all the way to 595, right? Done. We don't want to trade up here. There's no volume. There's nothing happening. We don't care. So why don't we just wait for price to come back to an area where there was a lot of volume and then see if we find support there, if we break. If we break, let's look for the other volume node, right? Simple. And this is something that we're going to dive into in the next class. We're going to go over, there's certain patterns that we can see in volume profile that can give us an even better read. But just, tomorrow, look at this, go find where your high volume nodes are. If you're trading somewhere where there's no volume, just wait for it to come back to a high volume node and see what happens. Because if we look at today, and I have it up here actually. If we look at today, where did we go? Right? So let's give me an arrow. Just using this is like no strategy, super simple. It's like this is where we saw that we were trading out of an area. Our high volume node is super low, right? Our high volume node is at 589. Give me price. Where's 589 at? Right? Oh, that's crazy. Just by looking at volume, solely at volume, and us assuming that we're going to wait to go back to an area of high volume to do anything, we would have very easily come all the way back down to almost 589 on the dot. right? Remember that this video is from 11, right? So that is literally right here. Right here, we could have looked at this. We could have said we are trading in an area with low volume. I'm going to wait for 589 because that is a high volume node. I'm not going to do anything until we get there. Simple, right? Don't even really need to look at the chart. Could have just looked at this. And then what happened? Came all the way back down to that high volume node, and then we bounced. If that doesn't explain how powerful that tool is, I don't know what will. Because a lot of people are looking at volume here and volume by time, right? This isn't going to tell you anything. If we're looking here, we're like, oh, high volume, right? This looks a little bit bigger than the candles beside it. We're going up. Maybe we're going to keep going up, you know? This doesn't give us the information that we need. We know that there is some action in here, but we don't know where. But if we just look at the volume profile, which goes by price, we could see that there wasn't as much action up here as we thought. And we know that there's a high volume node in a reachable area just below. So rather than taking calls at the top, right, we could have just waited and we came literally right there. Anybody, everybody understand how simple that is? There was no volume up here. We saw it on the volume profile. There was a lot of volume down here. And in this time from when that screenshot was, it only took about what, 45 minutes to come back down and hold this area. At that point, we could be like, hey, we haven't broken it. Maybe we're going to bounce here. And then you bounce to close the day. Simple, right? That's all you got to do. All you got to do is look at where the volume is horizontally versus vertically, and you can understand so much more, right? That's just a tidbit. We're going to go into that a lot more in the next class. But just tomorrow, when you're looking at the market, I want you to look at the volume profile, right? See if we're in an area of high volume or not, and then wait until we come to an area of high volume before you do anything. Just wait, come back to where people have been buying and selling. If we hold, if we're above it and we come down and we hold, you can go. If we break through it, you could probably short to the next one. Right? I just want you to check that. This isn't even an exposure. This is so much easier, right? Exposures are constantly changing, they're constantly in flux. Like this is literally just like where are the people? Where are people buying and selling? That's it. That's all we got to look at. And this isn't going to be right every time, but it's going to give you way more information than just looking at the chart. Because if you're up here and you're just looking at this big candle and we're pushing up, you see a lot of volume. I know a lot of people that'd be like, oh, we're probably going to go up now. And they'd be totally wrong. So I want you all to kind of watch this going into tomorrow, right? And just see how it reacts. You don't even have to take a trade based off volume profile, but I just would appreciate it if you go in, you look to see where the high volume is, and you wait to see what happens. Yeah, so volume profile, I do have it set up. Where is it? Down Firefox. I do have it set up so that it will convert to SPX, right? Go in, we add it. Bing, bang, boom, done. SPY should automatically convert to SPX. I don't know if we'll get a spot price here. Easy. So you can see right now, let's just go back to SPY because that's what I have open on the chart. 590.3, right? This is our high volume node. This is right where we close. Usually end of day, we'll see that. So I assume that this is going to be the area to watch going into tomorrow. Let's see what happens when price gets back to this. That's it. From here, we have a pretty big grouping. We have a lot of volume all the way to right around 588. And then it kind of drops off. And then our next major level is still that 585, right? So if we start to sell under here, we can come all the way back down. If we hold, we'll probably make a push up. Something to watch going into tomorrow, but super easy to understand, right? Find the biggest bar, right? If it's gray, nobody's really trading there. We don't want to trade there either, right? There's a lot of volume. A lot of people have bought and sold there. Let's see what they do then. Make your trading better in 3 minutes. Don't even need to look at the chart. It's like, are we at a high volume node? No. Maybe I'm gonna wait till we get to one. And then the last thing that we're gonna look at today is just kind of how to read the footprint. So there are two modules or two modes that the footprint uses. But the footprint is only looking at the orders that are at or under the bid or at or over the ask, right? This is important to understand because we don't care about orders at the mark, right? We've already discussed that orders at the mark do not move the market. And what we are trying to do with the footprint is find imbalances, right? We want to find places that, there's a lot of buying or a lot of selling going on. If people are just buying at the market at a price point, we don't really care, so we don't even log it on the footprint. So the way that the footprint works, and this is after hours, so the data is a little sparse here, but on the right, we're going to see people buying, right? So this is at or over, and then left is at or under. So the volume profile is not where those levels are from. Those are derived from something similar. So they're second and third derivatives. So it's similar to what they're basically generated from the open volume profile, right? But volume profile is going to change over the day, right? So you can even see, let's pull it back up. Okay, so this is the volume profile at close, or at least right now, and you can see that it's dramatically different than, where's the video? Than the volume profile at 11 today, right? So this is constantly in flux. As orders come in, it changes. The support and resistance levels are generated just from the open. As soon as the market opens, it takes the current price that it's trading at, and then uses a couple of derivatives to determine that. So volume profile is going to give you more up to date information, right? Because it's going to change and it's going to show. Like originally, this 585 was the main volume. As time goes on, because this is just a snapshot of the last 24 hours, that will change. And now we can see that the majority of the volume is way up here, right? Okay, so sorry, where was I? On the footprint, right? Green is people that are buying, red is people that are selling. So if we see a lot of red or a lot of green, and this is probably not a great example, let's go to the video, right? So a lot of red, a lot of green. We can see that sellers are in control. We can see that buyers are in control, and we're going to go into more detail on how to actually leverage this. Get out of here. I wish I could get rid of this, but I can't. So we're just going to look at this candle. In this specific example, so we're going to look at the 1045 candle, right? So these are 15-minute candles. Buying and selling is pretty equal, right? So when buying and selling is equal, it doesn't really give us, a clear indication of it going one way or the other. You tend to have trending moves when you're still in equilibrium. Let's see if we can find one here. No. What we want to look for, and I'm going to get more examples going into tomorrow when we actually start to record to show strategy here, is we want to see either lopsided. So we want to see like a ton of red or a ton of green, right? And I find that it's easier. I prefer to use delta, right? So here you have to read two sets of numbers. On the delta side, it's just a combination. So it takes the bid and the ask and it just merges them, right? So you can see it here. 0 on the sell, 32.80 on the buy. Delta is just going to tell us this is 32.80, right? It's net 32.80. So it just combines those two values. So both of them are showing the same information. It's just a little bit easier to read on this side. It shows kind of the absolute value. And then you'll see certain instances, and we're going to go over this. This is kind of it's tricky to do without having a day where I can show it. But you'll see at the top of each of these candles, right? Some of them have this little delta, like this one is delta negative 824. This one doesn't have that. This one has delta negative 88, delta negative 900. What this is for, yeah, what this is for, right, is if we have a green candle, right? So a green candle, hypothetically, and this is kind of where everything comes full circle. So if we're looking at a chart and we see a green candle and we're just looking at TOS, right? We kind of have this base assumption that there's got to be more buyers than sellers. right? We're going up. There's got to be more buyers than sellers. And there's certain instances where that is not true. And we'll go over this when we start to talk about limit and stop orders. What this delta shows is if we have a green candle, right? But there's more selling going on inside of the candle, which seems weird, right? Like that shouldn't be possible. How are we having more sellers, but we're going up? Or the opposite is true in this red candle. We have more buyers, right? Our delta is positive, but it's a red candle, so that shouldn't doesn't make sense, right? It gives you something to look at. So this is what's called delta divergence, right? So the footprint chart is one of the only things that can show this. And once we go into strategy, this is pretty big. This is basically what I'm using to determine reversals. Sometimes at certain points in the day, whether your highs, your lows, or a major level that we've traded at, the delta of the candle, so the difference between the buyers and the sellers does not align with the candle itself, right? And this tends to be points where fake outs are occurring, right? Or people are getting trapped. And it usually happens at the top or the bottom of the day and is usually very helpful to determine a reversal. Not always, but it is something that I tend to look at because hypothetically, right, we know a little bit about buying and selling, we know a little bit about candles. If we have a green candle, so where the price is going up, it would make sense that there are more people buying than selling. Now, there are certain instances where this isn't true, right? That's suspicious. That's kind of a weird thing. How are there more sellers than buyers, but we're going up? And it's this question that helps us start to it's refreshing here. That helps us kind of determine areas where we see reversals when things don't quite make sense and we're at the high of day or we're at the low of day and we start to see, it's like, oh, it's a red candle, but it's mostly buyers and we're at the bottom. That's when I start to sort of look at everything and go, are we going to start reversing here? Right. So all this delta number is if it's a green candle and there's more buyers than sellers, as should be, you won't see that delta number at the top, right? If it's a green candle and there's more sellers than buyers, which is a little strange, after hours doesn't really count. So you see more of this after hours, then it'll come up with the delta, right? So here we have a green candle, there's more sellers than buyers, shows up. Yeah. So we're gonna go over and where we get a lot of this volume profile and footprint information is from some Wyckoff methodology. So even in there, when we're going over it, there are times where this is more important. Like right now, if we were looking at the market, we know it's after hours. Price action is a little weird. We wouldn't, immediately see some negative delta and go, oh, we're going to go puts, or some positive delta and go, oh, we're going to go calls, right? The same is true during regular market hours. This stuff and the footprint in and of itself becomes more useful when we're at, high of day, low of day, or areas of the volume profile, right? So for tomorrow, what I want everybody to do, and I want you to show me that you've done this, right? I want you to generate your levels based off of the volume profile. So I want you to go in and we're just going to use SPY for tomorrow. I want you to find the high volume nodes. So let's go to this because it's a little bit better. I want you to find the high volume nodes and the low volume nodes. And I want you to just take on your chart and put levels where there is high volume. So in this specific case that we're looking at today at 11, I'd be like, oh, high volume right around 585.4. Boom, level. Okay, high volume right around 589, level there. And then let's go and just say 587.8 and a level there. And I want you to do that. And I want you to see how those levels actually are impacted throughout the day, right? I want you to see what we're doing there and what goes on. And 9 times out of 10, if we approach a level where you've seen high volume previously, it's a place where we will start to range and potentially change direction. So I want you guys to a lot of people struggle when they're newer. They go in, they look at the chart, and they're drawing their levels simply based off of, you know, are we consolidating here? What are we looking at? And sometimes they line up, right? So today you could have been like, oh, well, we have a little bit of a floor that's flipped right around 589. But we have confluence. So confluence is multiple things that are telling us the same thing, right? If we looked at this and we drew the level here, and then we looked at our volume profile and said, oh, yeah, that's also where the majority of the volume is, right? That's a good level in my mind. You don't need to draw it based off the candles. You could just look at the volume profile. Let this do the work for you. So I want you guys to go into tomorrow. I want you to draw some levels based off of this, right? So when market opens, I want you to look at the volume profile, draw levels where you see high volume nodes. A couple hours in, I want you to revisit those levels and revisit volume profile, and I want you to see if those levels have changed. I want you to do a second set of levels, right? After, let's say, 3 hours, I want you to do a second set of levels and see how our price action actually reacts when they get to those levels. Now, it could be above or below where spot price is today. It's clearly at this specific time, our spot price was over where these volume was. But right now, it looks like we're gonna, if we don't have any major moves before market open, we're gonna open right around the high volume node. So it'll be interesting to watch this. So I want you to draw levels based off volume profile and just watch how price reacts. So for everybody that is in here currently, right? I told you that we're gonna be doing some sort of giveaway. So I will be giving away 4 months of free access to all of Traderlink, right? So save yourself a couple $100. All I need you to do to get this, right? I need you to go into the testimonials. You are going to write what you learned today or what you're hoping to learn in the future out of these classes and a question, right? That's it. You go into the testimonials, write what you've learned, right? Are you happy? Are you sad? Are you annoyed? Do you hate my voice? I don't really care. Just write something. And then I want you to go into the questions tab and write a question that you have that we can answer in future classes. After you have done both of those things tomorrow, probably at end of day, I will be looking to see who did that. And I will be picking one name at random. I'll probably put it into a generator. And you can save yourself 400 bucks. That's it. Two things, super simple. Try not to write one word answer. That's a little lame. Let's not be like that. Yeah, I'll go write it in the chat. But that's how we're going to do it. Straightforward and to the point. One of you is going to win something. I also went out and bought, what did I buy? 4 iPads today that we're going to be giving away at some point in time. So I got to figure that one out. But let's get you guys in the habit. Like I ask every day, it's like, go write something in the testimonials. I don't care if it's bad. I can take criticism. We actually thrive on criticism. But you guys are here. You've taken the time. I know a lot of you were in the first class. There's, I think, 30 people in here for this class. You've been around. Go write something. Go help me out. Help me help you. And in return, one of you is gonna win like $400 in value here. Yeah, this is recorded. It'll probably be up tomorrow. Word. All right, y'all. That's it from today. So next week, I don't think I'm gonna get to a class this Thursday. We're gonna go over examples of how to actually leverage this, mainly the footprint in trading. But I really think that you're going to be able to see exactly what's going on if you just go into the volume profile, right? Make yourself smarter, make your life easier. Don't, draw random lines on your chart. Go in, see where the volume's at, draw your lines based off that, right? And then over the next couple of days, I just want to see I want you to see how price reacts at those levels. And I think that you'll be surprised that oftentimes we do come back to these. And oftentimes these are the spots where we can look for either a bounce or a reversal, the trend changing, but these are the spots we want to go. So for me, it's like when I'm looking at volume profile, I don't even want to take a trade unless I'm at a spot where there's high volume, gives me a better opportunity to see what's going on. I can learn and it makes my life easier. So I want to see you guys all do that. What is the volume profile basing its readings from? It's literally just taking the tape, right? So this takes the unruly, unreadable tape and just rather than reading it through, this crap, right? It takes all that and each individual order, 20, 10, whatever, and then it just slots it in. It's like one of those coin sorters, you know? Put the coins in and it's like, oh, this is a nickel. It's that easy. So it's taking this and giving you the ability to read it. That's the same thing that the footprint's doing as well. It's a little bit more complicated. And I think we're going to need some more examples for the footprint, but volume profile is something that you can put into your trading tomorrow. And, this is it's simple, right? We want to make things as easy as possible. Where are people trading? That's it. Easy peasy. All right, y'all. Thank you for putting up with me for another hour on a Tuesday. I hope you have a wonderful evening and let's touch base tomorrow. Use volume profile. Get some sleep. I'll see you in the morning. Thank you, everybody.